Hello and welcome to the UTI Mutual Fund Swatantra series powered by ET Now. You know that this is an ongoing investor education initiative. The idea behind this entire series is to help you understand your finances better, choose your products better, and of course get rich over the long term. We've gone from section to section. We've talked to young parents, we've talked to doctors, and today we have a very, very interesting set of audience members in the studio with me. These are small business owners, these are proprietors, these are entrepreneurs, these are people who are working very hard to create strong businesses of their own, and we want to make sure that their finances are also just as strong. Now, we will take questions from all of our audience members, but if you at home have a question for us, you know there's a website at which you can reach us, indiainvestkaro.com. That's at the bottom of your screen. You can also tweet out a question, #InvestKaro, and it'll be our pleasure to either have you in the studio or answer your question on the show. To help me answer all of these questions this week, I have two wonderful guests in the studio. R. Raja is the head of product at UTI AMC, and Ashish Goel is from Vista Wealth Consultants. Thank you so much for coming in, gentlemen. Now, before we start and I open the floor to questions, the biggest problem we realized from the conversation before we started the show is the ability to keep the professional business or those accounts separate from my personal accounts and the choice of what to do with the money when it comes in. And this was very interesting because it's also a problem we faced with the doctors we spoke to a couple of weeks ago. They didn't know whether to reinvest the money in their practice or actually invest it for their retirement. Raja, I'm going to start with you. How do I make that decision as an entrepreneur, as a business owner? Where do I draw the line between what goes in for my retirement and what goes back into the business?
It depends. See, one is the return. The second one is the diversification which has to be there. Business is just one company. It may do well, it may not do well also. So at that time, I think there should be something which you should bank upon in case business doesn't do well. And perhaps that's one of the reasons people, the personal wealth, you invest in mutual funds. And mutual funds perhaps provide a very good opportunity in the sense that if you invest in any instruments of any institution, there is a risk, there is a return profile. If it's a bank deposit, if you see, the risk return profile of all the products are same. Mutual funds are one where mutual fund is just a vehicle and the risk return profile is depending upon the underlying instruments in that. So with mutual fund various products, you have a risk, varied risk, and their potential for returns also depends, be it liquid funds, be it debt funds, be it equity funds, be it index funds. So you have a various choices to diversify, and mutual funds perhaps a little bit of money which you feel you can take it from the business, invest as a personal wealth in mutual funds, and that will provide you a great diversification in addition to the returns from the business.
You know, Ashish, normally when we give people advice on investing their money, we tell them to be very clear about what sort of return you're expecting and what sort of risk you're taking on. But for this particular set of people, the liquidity aspect is also going to be very important. Can I access this money in 2 days? Can I access it in 3 days? You know, real estate, for example, I can't access for 6 months to a year. So how important is it for me to understand liquidity of any instrument when I'm picking it out?
First, I would like to put more stress how to differentiate between the both, because until unless we are not able to differentiate whether this money which I have, let's say surplus, is my business money or my personal wealth, because the treatment is totally different. Let's say any money which is allocated for business and might be used for business, the liquidity is very, very important, because it might be needed any few days. Then that investment has to go in some liquid kind of funds, or maybe remain in current account, or maybe small term deposits. But if it is your personal wealth and you have kept as a personal wealth, then there are ways and means by which it can be kept separate. Then that money has to be invested in keeping your personal goal in mind, which can be your retirement, your child's education, higher education money, maybe your daughter's marriage, or there are a lot of other things also. So if business wealth, it has to be very liquid because you might need anything. If it is personal wealth, it have to go in a better avenues where liquidity should not be the concern, but achieving that goal is the prime concern that time. Then liquidity is not concern. But if you divide it well, then only you can do it. If you don't divide it well, probably you have to keep it every time liquid. Then the return maximization prospect is not that high. because if we keep the money liquid,
Yes.
the return will be less.
If you compromise on liquidity and risk, then you have to expect lower returns. I just want to do a show of hands for the people in this room. How many of you have personal health insurance policies? Okay, that's a great number. Life insurance policies, adequately 10 times annual income? Excellent. You're a very organized group of people. Retirement planning that is separate from the business that you're running right now, that you're investing in on a regular basis.
So you mean to say that you are talking about a retirement
Policies or an investment that you put aside for your retirement. How many of you have retirement plans? Okay, that's an abysmal number, and that's something we should worry about, because every salaried person has a compulsory PF deduction, whether they like it or not. They're being forced to save for their retirement, and as soon as you break away from that group, then it's your responsibility to make sure that you're saving a portion of every salary, or every portion of income that comes in needs to go towards your own retirement, irrespective of how the business is doing. That's not something we can compromise on. I would like to open the floor up to questions. You have a question in the front. Go ahead.
Yeah, I have a question here. Actually, how would you define the risk actually from the perspective of an investor?
It is not me to define, you have to, it is a customer has to see whether that his investment is available for which term, first of all, and at what rate of interest he wants to grow. Let's say suppose you are planning for your retirement, and which is, let's say 20 years or let's say 25 years or maybe 15 years back from now, then you can take probably risk more, and the growth rate should be high. Suppose let's say you are going from here to Mumbai, you have to go either by flight or either you go by plane. But if you are going to Europe, then you have no option but to go by. But we don't understand these small things in our day-to-day work. When we plan for our goals, so let's say goal is far, we have to take a vehicle which have more speed. If we take the vehicle which has more speed, we will reach the goal early. But if we keep thinking of risk in short term, then we will not able to take that vehicle. So it is a time horizon and the rate of interest required to reach the goal. Because let's say most of the times, if the clients see my retirement is this, and if we keep investing in, let's say, safe and debt instrument without taking the risk, he will not probably reach that destination. So it depends on the personal requirements more and which vehicle he wants to take to reach that destination.
There's a lady in the front who has a question.
We were talking about pension, saving for the pension, like for your old age. So I am investing in PPF. What else options, you can suggest me to invest in so that I can have a safer amount when I will grow old, I would be having, or I can at least look upon.
So PPF is the only investment you have so far for your retirement?
No, yeah. Apart from LIC, I am doing in the PPF only.
All right, Raja, you can use a mutual fund. There's no reason why not.
See, one thing is PPF is a good, but it's a fixed income instrument, gives returns, fixed returns. Does it take care of the inflation? That's where it is. See, when we say risk and returns, we see the third dimension, which is time. Some of them will be risky. Equity is risky in a shorter duration, but in a longer duration with a constancy to purpose, if you have a financial plan for retirement, equity can give you much better returns. And that's what we always say, investment is simple but not easy. Why it is simple? Even an index fund over a 15-20 years, the index has given a double-digit return, more than 15-16%. But the thing is, we don't have a sustained focus, we don't have a constancy to purpose, and we are carried away by the irrational exuberance and unjustified pessimism which marks the stock market. I think that's where we are diverted. And if you have a fixed goal or objective, and investing in equity, you can get much better returns than any other asset class, and that has been proved time and again. Of course, in India, the historic track record is much lower than US, but equities do give over a 10-15 year period. Even a passive fund gives much more return than any other asset classes.
But we need to have the knowledge of stock also.
See, mutual funds provide that knowledge. Mutual fund schemes give you the knowledge. You have and again, equity doesn't mean it's a diversified fund. You can invest in large cap funds, you can invest in various sources, and you have a core asset allocation and a tactical asset allocation and manage your portfolio.
I have to take a very quick break, but we'll come back. Our guests are still with us, our audience is still with us. Remember, tweet a question if you have one, and don't go anywhere. Welcome back. You're watching the UTI Mutual Fund Swatantra series powered by ET Now. Thank you for staying with us. We have a lot of questions and a very interesting discussion going on in the studio right now. There is a question I understand over here. I'm going to start with the gentleman.
Our finance minister launched a new product, REIT, a real estate investment trust. My question is, what is the difference between mutual fund and REIT? And UTI is also launching this product or not?
REITs is a product where it's not a mutual fund subsidiary has to be formed, and they will launch a REITs because REITs has been there for quite some time. The regulations have come. At the appropriate time, the mutual funds, there are certain tax issues in that. Once everything gets sorted out, because the budget has given much more clarification, the mutual funds will launch a product. But REITs again has lot of restriction. It's not just buying real estate. It's not equivalent to buying real estate. It's equivalent to buying certain property where the rental income comes, and you get a part of the rental income. But that's, in fact, in US it has been quite popular, and India also, with much more clarification in taxation and regulatory issues, the mutual fund will start launching those products.
Is there another question? Yes.
My question to you is, why mutual funds sound so risky? And what points should be taken care of before choosing any product? And how to depend on any advisor?
Ashish, you want to take that?
Yeah, I'll take that. So why they give that disclaimer कि it is subject to market risk is, so we don't want anybody to misguide, you know. So it's a very transparent industry, and it is very clearly we want to show and articulate everything very clearly. It is, there are some risk involved in it, and person should read those risks and, you know, also understand how to mitigate that risk. That is first part. So it is why it is said, because it has some risk, and we want to be very transparent, and we are proud to say our industry is the most transparent industry we can vouch for. It is one of the most transparent industry. Now coming to your question, which is how to choose mutual fund, you know, I think it has one layer before. You know, before choosing the mutual fund, you know, you have to choose one good advisor also, trusted advisor, who can help you to choose mutual fund according to your need, requirement, and risk profiling and your goals, and which answers the questions, you know, where should I invest for my pension fund? Because, you know, we have seen people plan more for their vacation, and then they don't plan for their life planning. Yeah. So once you have good advisor, they can tell you which is your, let's say, short-term requirement and which instrument should be taken, which is your long-term goals like your retirement and all, and for which instrument should be taken, and what are the risks involved. And then it becomes very easy to choose the funds, because he's in a way mentoring you to understand what are the basic things involved in it. If you don't have an advisor with you who can guide you, then it becomes slightly complicated, because there are so many products. Then you have to basically understand first the concept. What are the concept and which is suitable to my needs.
My question is also the same thing. What are the key parameters one has to take care before investing any money, his hard-earned money, on any mutual fund? You are saying appoint a good advisor. Again, advisor will sold only those things which has been forced to sold him.
Suppose you want to marry, so I'll answer in a different way. You want to marry, let's say, your daughter. You know, how will you find a good match? You will do a lot of things, you know, background, reference check. Some, let's say, if he's doing job, so you will also have, you know, in that fashion, it's very, you know, simple thing. Sometimes it becomes, so we have a pre-mindset in our mind, kid advisor will have some targets. It is not like that, you know. So it's good you all have that feeling. So I feel my business prospects are very much, because everybody feels that way, so you can have a lot of customers. So try to understand first. One is anybody who has legacy, for how long he's been doing the business. That is one part, you know, some testimonial to show. Then infrastructure, what infrastructure they have. Then whether they have online facility to show you transparency, can they show the portfolio, team, whether they have team or not. So we have a checklist for ourselves also. So whenever we meet new clients, so we give that checklist to the client. See whether you choose your advisor first very diligently and carefully by that checklist. And if we also qualify in that, choose us. Otherwise, find better one for yourself.
So it's actually like hiring someone and giving him instructions like you would do in your business. So you have to be very clear also about what you want. You can't leave it all to the advisor. All right, I'm told we have to take another very quick break, but don't go anywhere. This very interesting conversation will continue after the break. Welcome back. You're watching the UTI Mutual Fund Swatantra series. Thank you for staying with us. We have a lot of questions that we'd like to get through on this show before we wrap up. There's a gentleman in the front who has a question. Go ahead. Good evening.
My question is that when we have some spare funds in the company, we could either put it in some kind of an FD or put it in stocks, or even go towards reducing our working capital limits and saving interest on that. How does investing in a mutual fund compare to that? It's business money. So can we not look at a mutual fund which is liquid and we can use it, but it gives us a better return?
Sure. Oh, hang on. Raja's the product guy here. I mean, there are funds designed exactly for this purpose.
There are funds defined exactly. You have the liquid funds, perhaps 1 day or 2 days. The one plus point, which it scores over bank deposit, you don't have to decide the investment horizon. If you have to have bank deposit, it should be 7 days or 15 days. You should decide in advance. Liquid funds, you can keep it for 5 days, 6 days, whenever you want. With a day's notice, you can encash it. If somebody wants slightly a little bit scope for higher return, but is willing to keep it for 15 days or slightly more than that, you have ultra short term funds which slightly have a higher maturity in their underlying portfolio. And then you have various investment horizon. You have short term funds, you have for a slightly 1 year and above. So we have various investment horizon related products. And
tell us what the return expectation on these funds are vis-a-vis a fixed deposit.
See, as far as liquid funds is concerned, basically on an average, this is past track record, again depends upon the underlying securities returns. They have been giving at the range of 8 to 8.5%, and you, of course, that the tax arbitrage which was there before is slightly is still there, but not as much as before, and it gives 8 to 8.5%, and that perhaps compares very well with a very short term deposit of other
technically
instruments.
The taxation now of a liquid fund is identical to a fixed deposit, especially if you're looking at a few days. So there's
for
no
an
difference
individual
there.
marginally is there. If it is there, some dividend distribution tax is slightly lower than the marginal rate of taxation for the individual. For a corporate, it's very marginal, it's almost the same. Still there is an arbitrage for an individual.
All right. I'm going to take a question from the back there, the gentleman.
I was just asking, does SIP help in investing better, or it is helping better in small investments?
First of all, apart from the returns, whether SIP a little bit, SIP gives additional returns, but more than that, the discipline which it creates. You have a long term, what I always mention, constancy to purpose. You have a discipline. You invest according to that. You don't worry about the markets. You don't time the markets. You invest certain amounts every time, and that focus which is there, a long term focus with 5 years or 10 years towards a goal, that discipline which is there in SIP, that gives you benefit in the long run.
Actually, Ashish, for someone who runs their own business, it's not a salary. I might not get the same amount of money coming in month on month. Then making a commitment to an investment, saying I will commit this much every month, might become a little bit challenging. So what advice do you give someone who doesn't have a regular steady income that that can be relied on? If I have a fluctuating income, how do I pick an SIP?
Then in that case, we suggest to have a systematic transfer plan. Let's say, so suppose somebody is doing, let's say we suggest according to goal, he has to do a retirement SIP for, let's say, 15,000 rupees a month, and he don't have that regular income coming in, and per yearly in the year the income will definitely come. So what we can do is we can park the amount in liquid fund whenever that surplus is available, and from there we can do the systematic transfer plan to the equity fund. But definitely we feel when it gets transferred, the money will be locked in for long period of time. Then only we will suggest equity. So we can do first invest the base scheme, which is safe, liquid, and then from there we can do the systematic transfer. And he keeps filling that. It's like a big water tank which we keep filling, and from that water tank we can keep withdrawing slowly and steadily.
All right. The gentleman in the front, go ahead.
Hi, my name is Puneet. My specific question to Ashish, supposedly assuming that me personal and my business, if we have a surplus fund of rupees 2 crores, so what do you suggest me to invest in? Is it a property which gives me a good rental, or mutual funds, or any kind of other options?
Couple of things you have to consider with real estate: maintenance, tax, there's property tax on it. You'll have to manage that rental, so you have to bring in a tenant, you have to make sure that the tenant is comfortable, painting. There's a lot of things that have to happen with real estate, and it's not as liquid as you think. It takes a year, close to 6 months to a year, to sell real estate. None of those things apply to a mutual fund. But if you were to choose like that, and I still think you should have a goal before you make your choice, how would you recommend you make that choice?
First of all, you said your personal and business wealth cumulative has 2 crores. I will.
Correct.
First of all, I would like to understand what is the requirement of that fund. How much time you have. First thing is divide that wealth mentally, at least, which is my personal wealth and which is my business wealth. It will help you, because if it is your business money and you want that money to be pumped back sometime soon in the business, then probably, let's say, you can't park in real estate.
No, if not.
You don't require that money?
No.
You have long-term
long-term
availability of that money with you. Now, if you have long-term money available with you, what do you want with? You want regular income immediately, or you want to build regular income for your retirement?
Somehow I feel that if I invest it in a real estate, it will give me a regular income of rental as well as the appreciation. Somehow I feel that. I don't know how true is it.
You are talking about the reward right now. You will have regular income also. So if you are talking about, let's say, commercial real estate or
Commercial.
What rate of interest do you think you will be able to generate from commercial real estate?
Apart from the appreciation of the property,
just the rental income.
Just the rental income, maybe about 8% per annum.
8% is quite aggressive.
Yeah, it is aggressive.
Quite aggressive right now. So I'll just give you some example of Mumbai. So Nariman Point was the D location.
Correct.
Now BKC coming in. Parel coming in, what I have heard, and I've seen many buildings which are 50% empty. Now think of those guys who are getting, so high rentals from them, and now the 50% of the buildings are empty. What will happen to their financial planning and their family income if the 50% of the buildings in Nariman Point, which is supposed to be the best commercial location in India, is 50% of the building happening? Because, you cannot think the real estate will keep giving the returns regularly, because the smarter buildings are coming. This is a smarter building. Probably much more smarter building will come, and every corporate will like to go there. And normally it comes in the suburbs, and the cost of land is also. So there are chances the corporate will also like to move to the suburb and reduce their rental cost. As of now, India, the rental costs are the top 5 to 10 cities in world. So you have to rethink on those lines also.
All right, unfortunately, we've completely run out of time, and I've been told to wrap up the show. But thank you so much for coming in. We should stay after the show is over and continue to chat. Gentlemen, it's been a pleasure to chat with you. Thank you so much for watching. Remember, if you have a question for us, indiainvestkaro.com or #InvestKaro on Twitter. It'll be my pleasure to hear from you. Thanks so much for watching.
Brought to you by UTI Mutual Fund. हक एक बेहतर जिंदगी का.
Mutual fund investments are subject to market risks. Read all the scheme-related documents carefully.